Hello everyone. We are delighted to have you once again with us for another edition of our series on insurance and reinsurance concepts. I am Aymen, Senior Treaty Underwriter for MENA region.
Hello, it's a pleasure to welcome you all. I'm Sarah Khalifa, Treaty Underwriter for MENA region. Today, we are addressing a topic that's gaining strategic importance in our industry, which is Takaful and Takaful insurance.
Definitely, Sarah. Takaful is an alternative to conventional insurance based on principles of mutual cooperation, shared responsibility, and compliance with Sharia law.
Let's break it down simply. The word Takaful is an Arabic word, meaning mutual guarantee. The idea behind the system of Islamic insurance is that participants contribute to a common fund to help each other in case of a claim.
Indeed, unlike conventional insurance, where premiums are collected by the insurer as revenue, in Takaful, contributions go into a policyholder fund and the operator manages that fund on behalf of the participants.
Let's now focus on Takaful principles. In fact, there are three main essentials. First one is the absence of excessive uncertainty, name it in Arabic gharar, means that contract must be clear and transparent. Secondly, prohibition of interest, name it in Arabic riba, as the fund's investment must comply with Islamic finance principles. And finally, speculation, name it in Arabic maisir, is also forbidden. Obviously, Takaful aims to ensure equity and balance between stakeholders.
Furthermore, a Takaful company must comply with the following fundamentals. First, the establishment of a Sharia supervisory board which monitors the compliance with Sharia law. Then, the separation of policyholder fund from shareholder one. Also, the commitment to distribute technical profits to policyholders. And finally, the avoidance of Sharia non-compliant assets.
Now, let's dive deeper into how Takaful is actually managed. In fact, there are three commonly used models that operators use, depending on the country, regulation, and market preferences.
Right, Sarah. First, there is the Wakala model. In this setup, the Takaful operator acts as an agent and receives a pre-agreed fee for managing the fund. This aligns with Sharia requirements for clarity and transparency in fund management.
Exactly, Aymen. That fee is usually deducted from the contributions paid by participants. It's a transparent and structured model, where the operator has no claim to any surplus, just the management fee.
Now, the second model commonly used is named the Mudaraba model. This one is based on a profit-sharing concept. The operator becomes an investment manager, and both the participants and the operator share the investment profits based on a predefined ratio.
Definitely, Aymen, and I like the Wakala model. Here, the operator is more involved in investment performance and benefit when the fund performs well. However, the risk remains with the participants.
And finally, we have the hybrid model, which, as the name suggests, combines both Wakala and Mudaraba. It allows to benefit from the advantages of both models by ensuring better financial sustainability even in years with low investment income.
Ultimately, each model has its pros and cons. The Wakala model offers cost transparency. Mudaraba encourages strong investment performance, and hybrid allows customization and adaptability with market's regulations.
In practice, the choice often depends on what the regulator allows or what the Takaful operators are most comfortable with according to their shareholder strategy. Besides, some regions favor one model over another. In Tunisia market, for example, Wakala model is used for underwriting and administrative tasks, and Mudaraba model for investing the surplus or reserves.
Let's now talk about reinsurance aspect. Just like in conventional insurance, Takaful operators also need reinsurance. That's where Takaful comes in.
Of course, the Takaful companies operates on similar ethical and legal principles as Takaful firms. They manage a separate fund to support Takaful operators when losses exceed their retention.
Exactly, and in the same spirit, Takaful follows the same models, Wakala, Mudaraba, or hybrid, and must undergo Sharia audits and compliance screening.
Sure, and this makes selecting a Takaful partner not just a matter of capacity, but also of Sharia alignment, in addition to financial strength, governance track record, and compliance requirements.
Given the growing importance of Takaful and Takaful as key drivers of growth and diversification, Tunis Re established its Takaful window in 2011, Over the past 14 years, we have successfully built a strong and sustainable Takaful portfolio.
Effectively, Sarah, Tunis Takaful stands as the pioneer Takaful entity operating in the Tunisian market, carrying out all its activities in full compliance with Sharia principles under the guidance of its Sharia Supervisory Committee.
In fact, and in accordance with Tunisia's underwriting guideline, we offer a wide range of Takaful solutions tailored to the specific needs of Takaful operators across the MENA region, as well as in various African and Asian markets.
We have now reached the end of our session. Thanks a lot for your attention and for being with us. We hope you found it insightful.
Thank you once again for your time, and don't miss our upcoming expert insight into the world of insurance and reinsurance.